Good evening, everyone.
Good evening, sir.
Yes, today we are going to discuss about investment. Actually, we have to discuss three topics. One is investment definition and investment opportunities and benefits and major categories of investment, those things. Second topic is evaluation of investment. There are so many types of investment. So when we invest or when we choose best investment, we should evaluate the investment and take a decision what is the best investment for investing our funds. And third one is microfinancing and lending facilities. So we have three topics I have to discuss today. Actually, I am not going to discuss these three topics today. I hope to discuss some topics in our next lesson. Next session is 25th. So today, I plan to discuss some areas of this chapter. But first of all, what is investment? What is investment? Investment, when we talk about investment, we know money. We think money. Investment is based on our cash or cash equivalents or asset. But we think about the money and our time, our effort. Those are we call investment. In your childhood time, school time, you invest not only your parents' money and other resources and time as well. You invest your time for your studies. So here we consider not only money but the time also. For example, if you have 50 million rupees, you have 50 million rupees. So you have so many choices to invest your 50 million cash. When you take a decision about investment, you should consider your benefit, the future benefits. Once you invest money today, your target is earn profit in future. 1 year or 2 years or 5 years or 10 years, right? You expect, your expectation is earning profit or interest. So that purpose, you decide the best choice. How do you decide the best choice? If you have 50 million rupees, so you have to consider lot of things. about take a best or select a best choice of investment. One is you think about your future earnings or profit. So your target is earning profit. So you search the market, investment market, and collect information about interest rate or uh, profit or whatever the earnings. Not only consider earnings, we consider the risk side also. You know, in financial market, there are lot of financial institutions are there. If you like to earn more profit, then the risk is very high. For example, your 50 million rupees, you invest your money in a bank. You open a savings accounts, or government bank or private bank, whatever. You open a savings account and deposit your 50 million rupees. Then the risk is very low. When you want your money, you can withdraw your money, right, for your choice. But the return mean the profit. When you deposit bank money to the bank, your earnings is we call interest rate, interest. When you put your 50,000 money in the savings account, the interest rate is very low level. In percent, you know, very small amount of interest are paying by banks when you put your money in your savings accounts. But risk is very low. Profit also very low, small profit. This is one choice. Second one is you can decide to invest your money in a bank, not put your money in the savings account. You know, there are term deposit. We call term deposit. Term deposit, in other words, fixed deposit. 100 days, 200 days, or 3 months, or 6 months, 1 year, and 18 months, or 2 years, whatever. There's a time period. Within the time period, we can't get back your deposit. So you deposit your money for a fixed rate for a certain period. So when you deposit your 50 million cash in fixed deposit for the time of 6 months. So between this 6 months, you can't withdraw your money. If you want to withdraw your money, the bank will pay the small amount of interest. After maturity period means you deposit your money for a 6 month. So after 6 months, we call your maturity period is over. So after 6 months, you can withdraw your money. So here also, the bank pay interest rate. This interest rate is higher than savings account interest rate. So 8% no, 9% no, 10%. This is another option. These both options are right, very easy to take decisions. Right? Every person easily invests their money for this two options. Savings accounts or fixed deposit. Low return and low risk. In third one, you know the share market. Share market mean, you know the share market in limited company, public limited company sells its shares through share markets. So there are some experts are there. So we analyze the share market trend and study well, and we can purchase shares and we can buy and sell it. So we invest our money into the share market. Right? So before invest your money in share market, the market analysis or share market analysis is very, very important. Otherwise, you can't lose your money. So there are some agencies, there are some brokers, there are some experts are there. We can get some advices from those expert people and we invest our money into the share market. So here the share market investment gives you sometimes you can earn more profit. Sometimes you will use your capital also. Right? There is a risk. But earnings are higher than savings accounts or fixed deposit, and risk also higher high risk and high profit. Without analyzing this share market, right, we can't deposit. Okay, so higher income, higher risk, lower income, low risk. This is third one. And think about other alternatives. You know, there are some financial companies, right? They gives you more interest rate or more returns. But the security is the problem. The problem is investment security, right? But those type of companies paying more profit. But the risk is, can we get back our investment at the end of the period? That is the risk. Okay. You know, there are several cases, those type of investment. Depositors are like to get more profit, then they want to more profit. So they invest their monies to this new financial companies. You know, there are some fraud activities also there. So risk is high. Another option. And you have money, so you think, I'm not going to deposit this money to the bank or share market or other financial companies. I like to start a business. So you like to start a business on sole proprietor or partnership or start a company, whatever, you start a business. So you start a business. Before you start a business, you think about the market and you plan your investment and the business type of the business, right? That is another option. That is your choice. Okay, right, start a business. Another option is you invest your money this type of business. For example, land business. You buy land and sell, buying and selling. So you have much money, you purchase lands and sells lands with profit. So that is another type of investment. And vehicle business. You buy car or other vehicles and you sell the vehicles. That is another type of investment. Those are called investment. Business or deposit or share market investment or real estate investment. Right? You invest properties. Properties mean you buy houses, you buy buildings and rent out. Then you can earn profit, profit, rent income. Right? That is also investment. You can invest properties also. Okay. There are so many investment opportunities are there. So you invest not only your money, your time also. You invest your time also. When you invest your money, your objective is, your target is getting more profit. So your target is future benefit, not present benefit. You target your future benefit. Future means, there is uncertainty. You can't sure this much of income you decide, you plan, right? I invest my money, this type of investment. I think this much of profit I can earn in profit in near future. But that is not fixed. When you deposit fixed deposit or savings accounts, you know your profit. You know the interest rate. So you already know your profit level. But you invest your money share market or other properties, stock or buildings, land or machineries, vehicles or whatever, you don't know about your profit. But you know you will earn profit. Sometimes you will earn profit. Sometimes losses are there. Okay. So you invest your money, your time, your effort, right? So this is called investment. Investment is an asset acquired or invested into build wealth or save money from the hard-earned income or appreciation. Okay. You know the retirement plan. If you work government sector, so you know there are pension schemes. If you work private sector, you know the EPF, ETF, Employment Provident Funds, Employment Trust Fund are there. Then you can start your retirement plan. There are some retirement plan you can see in the financial market. So People's Banco, private banks and BOC, you can start retirement plan. Yeah, there's an initial deposit and monthly you have to deposit a certain amount of money. Then after your retirement, you can get the benefits monthly or annually. You can get your benefit, right? That is called savings plan. For another example, insurance policy. If you take insurance policy, life insurance, life insurance also investment, one type of investment plan. Why? When you take a insurance policy, life insurance policy, you think about your life risk, right? So for that, you get insurance policy and you pay monthly your installment. End of the maturity period, you get back your insurance value, the amount plus bonus, right? That is called benefit of insurance. Within the maturity period, is there any incidents, then you can get benefit from insurance policy, right? So when you invest, the objective is, one objective is saving. When you get insurance policy, your objectives are not only savings, you can get your money and profit, profit we call bonus, end of the maturity period. So that is also savings plan. Not only savings plan, but within within the maturity periods, there are some incidents, unexpected incidents, you can get the benefits also. So that is one objective. Another one is gathering regular income. Regular income means when you invest your money for a business or whatever, bank or fixed deposit or savings account or whatever, regularly you gathering income, you get income. Monthly or quarterly, you get income. Right? That is another object. Sometimes you invest money, for example, you purchase land. the land value is day to day, the value is going up. So we invest land, we purchase land, the risk is very low. Why? Right? When you invest your money share market, the risk is very high. When you purchase land, your risk is very low. But some period of time, 2 years or 5 years or 10 years, you can sell your land, right? And you can get benefits, right? So there are 2-3 objectives: savings plan, gathering regular income, or achieving capital appreciation, right? Those are we call objectives of investment. Okay, so investment is very, very important. If you have enough money, so you should select a suitable investment policy or investment method. So when you invest, when you take decision about your investment method, you have to consider a lot of things. Some things I have already discussed with you. In the accounting side, there are certain techniques are there. There are certain techniques or methods are there to evaluate your investment. Okay, right. Before discuss the methods, what type of categories are there in investment? I discuss some categories, some types of investment. Savings account and fixed deposit, those are called cash equivalents. Share market, cash equivalents means those are equal to cash. Why? If you open a savings account, you deposit your money. When you own your money, you can withdraw through ATM or other methods. So those are called cash equivalent, equal to cash. Savings accounts is equal to cash. Equal to cash. And fixed deposits also equal to cash. Those are called cash equivalents. Share market shares, those are cash equivalents. Equal to, not cash, but equal to cash. If you want convert to cash, you can easily convert cash. And other categories, stock, right? You purchase, right? Jewelries or other vehicles, right? Machineries, other type of goods. And bonds. Bonds mean treasury bonds. We call those are lending instruments, right? And real estate business. Those are we call types of investment or categories of investment. Okay, right. Understand about investment. investment subject is very, very useful, right? Sometimes, some people are there, they get loan, they get bank loan, then get loan and deposit or invest this loan money to getting profit. When you get loan and invest this loan to another investment, you think about not only your risk, your profit, the net profit. What is net profit? Net profits mean when you get loan, when you obtain bank loan, you have to pay not only installment, initial amount, capital, but also we pay interest and other charges also. When you get bank loan 1 million for 5 years, you get 1 million loan for 5 years time, and each and every month you have to pay installment. There are two items in installment. One is capital, initial amount, the loan amount plus interest. After the period, the end of the 5 years, you think about your payments. You get 1 million, end of the 5 years, you paid 10 million plus amount. X amount. X amount means bank charges, document charges, and late fee and profit interest also. So when you obtain bank loan and invest your money, investment, after 5 years, you compare your cost of investment. What is cost of investment? The interest rate, document charge, late fee, those are we call cost of investment. Why? We get loan, for that we pay extra money. This is one side. You know the cost, extra payment. And other side, you calculate your profit. You invest this loan amount, 1 million, to the business. The end of the 5 years, how much of money you earn from this investment. If your earnings are more than cost of loan, cost of investment, then your choice is okay, good. You pay 350,000 for interest and bank charge for this loan, extra payment. When you get, for example, when you get 1 million, after 5 years, you pay 1.3 million. 1.3 million means 300,000 overpayment. Why you pay 300,000? That is, the cost of investment. That is interest rate and document charge, late fees, like that. So you invest this 1 million business. After 5 years, you earn total earnings is 500,000. So your cost is 300,000. Your extra payment is 300,000, but you earn 500,000. The net amount is plus 200,000. Profit 200,000. So your investment is okay. Why? You obtain bank loan 1 million. For this loan, you pay 300,000 extra payment, and you you invest your money, and your earnings are 500,000. Then your net amount is plus 200,000. 200,000 profit. In other side, you pay 300,000 extra amount, and your earnings is 250,000. Your earnings is 250,000, but you pay 300,000 extra for interest rate and other things. So here the net amount is 50,000 loss. 50,000 loss. Right? This is good option. No. Why? Your cost of capital is 300,000. Your return is 250,000. So you lost 50,000. Not only cash, your time also. But when you take decision, we consider initial deposit, initial amount, and the earnings, end of the period, how much amount we earn from your investment. And third one is disposal value, scrap value or disposal value. What is disposal value? When you obtain a bank loan 1 million, then you purchase a machine or vehicle or a property, your property. But your earnings is 200,000 from this property, as you know, whatever. But you pay 300,000, right? Here, 50,000, you lost 50,000. But the end of the 5 years, you purchase machine. So you have the value of machine. So end of the 5 years, you can sell this machine or property, say 400,000. 400,000. Then your net amount is how much? You lost 50,000, but your disposal value is 400,000. Then your net profit, net earnings is 350,000. So your investment option is very good, useful. Okay. So when you take a decision, you consider not only the monthly or regular profit, after the or end of the period, how much of amount you can receive from investment. For example, disposal value. When you purchase buildings and machineries, vehicles, there are disposal amount, scrap value. So those things should be considered for select the best investment policy. Okay, so here we should consider initial amount and the disposal amount, scrap value, and regular earnings. right? Not only these three, you consider your time, your effort, your risk, right? You should consider those things for select a best investment policy. For that, there are some techniques are there to evaluate investment. To evaluate investment. There are certain evaluation methods. Certain evaluation methods. Right? So this is we call evaluation techniques. Evaluation techniques. These are the evaluation methods. Internal rate of return, IRR. This is a common investment evaluation method. Okay. Cost benefit analysis, CBA. Here we compare cost and benefit. The investment cost and benefit from investment. Next one is payback period. Payback period, I will discuss this method. Payback period means if you invest 500,000, right? How many years it will be taken to get back your investment? 500,000. 1 year, 2 years, 3 years, or 5 years. Right? How many years? If you invest 500,000, end of 2 years, you can get back your initial deposit, 500,000. After that, right, you get profit, no? You get profit. That is called payback period. When you invest a certain money, how many years it will be taken to get back those investment. And another method is ROR, return on investment. Return on investment. Another method is common method, accounting rate of investment. Accounting rate of investment, right? Another method is net present value, NPV. NPV. Here, the best method is net present value. Because when you consider our returns, right, you don't think about the initial amount, the face value. You should think about the value for money. What do you mean by value for money? Now, today, you have 100,000. Today, you have 100,000. So, you can spend this 100,000 and you can purchase goods. Right? After 1 year or 2 years, can you buy the same amount of goods using this 100,000? It is possible. No, we can't say possible. Why? You know the inflation, price level, price level. You think the 10 years back, 10 years back, you can, right? The price level is very low. Low mean compare this period before Corona, COVID-19. But this time, you know the price, economic problem, inflation, no, there are limited international transactions. Okay. So we consider not only cash, you consider value for money also. The value of your investment. If you have 100,000, today you spend your 100,000, purchase some amount of goods. After 1 year, the same 100,000 you can spend, but the equal amount of goods you can't purchase because inflation. So net present value mean we consider value for money, inflation, interest rate, and you calculate the present value. When you get profit after 3 years, for example, 100,000, after 3 years, you can earn 100,000, but you calculate the present value of 100,000 is how much? The end of the 5 years, right? You receive 100,000, 5 years or 2 years or whatever. But now, that 100,000 equal to 100,000 or less. Right? Not equal to 100,000. Why? The prices are different. You know, in third world countries like Sri Lanka, our prices are right increasing. So the value of future amount is low. So we consider the value for money and the present value of money. This is the suitable method. Right? NPV is the suitable method for taking decisions. Okay, these are called investment evaluation methods. Okay, when you evaluate these methods, there are key aspects are there. One is we call risk assessment. Risk assessment. We analyze the risk and study the risk and identify the risk. Right? Return potential. The returns, the interest rate, dividends, and depreciation. What do you mean by depreciation? Depreciation means this is not plus, this is minus. Depreciation means when you purchase machinery or furnitures or other things, after usage, some much of money or amount, right? We calculate for depreciation. Why? When you using this asset, the value of assets are decreasing, right? We can't sell the price which you purchase. Okay, that is called depreciation. Depreciation. So we should consider the depreciation also. Why we calculate depreciation? This is also savings. Depreciation also savings. Right? Okay. So you should consider the return potential and financial analysis. So you analyze your investment that is financially healthy or not. Here you consider risk also. And market analysis. Before invest money, we should analyze the market, the trend of market. What are the needs? What are their expectations? Right? And securities. Right? So, we should analyze the market. So, you get research, market research. Based on your analyze report or market research, then you can take a decision about your product or services or other things. So market analysis is very, very important for business. And valuation techniques. I already explained you. There are 5 or 6 valuation techniques, AIRR, IRR, right? Internal rate of return, accounting rate of returns, payback periods, net present values are there. So we consider the valuation techniques also. Those are the things we call key aspects of investment evaluation. Before evaluate your investment, you consider these things also. Right? Is there any questions? So this is a practical session. Investment is a practical session. This is useful in your life. You know, some right? Some persons are there. They wants to buy a bicycle or three-wheel or car or whatever vehicle. What they do? They get loan from bank or other institution. Then they purchase vehicle and paying loans monthly. At the end of the period, you know, right? You think your disposal value. Disposal value mean end of the period, the value of asset. Okay. So when you think about our investment, I already discussed the risk and other things. and the techniques. This is called mathematic techniques. So using these techniques and select best one and evaluate your business or investment, then you take the investment decision. Okay. So next we discuss about these methods one by one, and we have to do some calculations also. Okay. So I am not going to discuss all these methods today. I plan to discuss one or two methods, and rest of other methods I will discuss next class, or if you have another extra time, I will discuss. Okay. Is there any clarifications, any doubts up to now? You can ask. So this is, I already told you, this is practical for your day-to-day life. Day-to-day life. If your choice is wrong, you lose your investment, not only cash, your effort, money, everything. Right? So here your decision is very, very important. Very, very important. Okay. So this subject is very, very important. Okay. Right. We will take a small break. Small break. Up 10 minutes. After break, I will discuss one or two evaluation methods. Okay. Right. Now time is 8:43. So 8:55, we will continue, start our discussion. Okay. So 12 minutes break. If you have any clarifications, any doubts about this discussion, you can ask, or you can type your questions in text box, right? So I will explain. Okay. 8:55, we will continue again. Okay, we will start. Before calculating investment, you should identify the investment risk. Here, the risk is loss, losing your money. That is your risk. When you invest certain amount of money, your target is get back the initial amount, at the same time profit, more profit, maximum profit. When you lose your money, your investment, that is your risk. right? Then automatically you lose your profit also, no? So high risk investment usually comes with a higher potential return. High risk, high profit, high return. Low risk, lower potential return. That is the rule. If you take risk, you can get more profit. If you like to avoid risk, so your return is very low, like a savings account and share market investment. Savings account or savings, the fixed FD deposit are low risk. Why? 100% you can get your initial deposit plus interest. But when you invest share market, right? Sometimes you will be lose your money. Sometimes you get more profit. So risk is very high, return also very high. Okay. Therefore, the analyze is very, very important when you take investment decision. Okay. Right. So two methods I like to discuss. Two methods. One is called payback period. What do you mean by payback period? Payback period is, this is a simple method. When you invest 100,000, for example, you deposit or you invest 100,000. How many years it will be taken to get back these 100,000? 2 years, 3 years, or 5 years. Okay. So you have 100,000. You have two choices. You have two choices. If you have one choice, not need to evaluate. Why? We have no choice. We have only one. So we should invest your money to this option. Why? You have only one choice, no? If you have more choices, if you have more choices, more alternatives, then you select the best one. How do you select the best one? For that, you use these techniques and use the suitable techniques and evaluate the investments, alternatives, and select the best one. For that purpose, you use these techniques. But only one choice, not need to analyze. Why? Only one choice. For example, if you, in your life, if you select your life partner, there are 5 choices. 5 proposals are there. What do you do? You have 5 proposals. Then you have to select one proposal. So you evaluate the 5 proposals, right, based on your decided criteria. You decide or you consider these things or criteria, and based on these criteria, you evaluate your proposals. Finally, you select the best one, isn't it? Yes. Likewise, in investment also, you have so much of money, certain amount, and there are alternatives, one or more alternatives. Then you have to select one. How do you select? Right? Randomly you can select? No, you can't select randomly. Then you should evaluate. How do you evaluate? Right? Then use these mathematical techniques and evaluate the investment alternatives and select the suitable one. Okay? Right. If you have one choice, there are no selections, no evaluation. Okay? Right. The simple method is payback period. Payback period means I already explained you. Once you invest your money, how many years it will be taken get back? 2 years, 3 years, or 5 years, or 10 years. So, for example, if you have 3 choices, right? You invest 1 million. Your money is, investment is 1 million. You can invest your money in 3 investment policies, A, B, and C. Okay? Right? I will explain these in Excel sheet that is easy to understand. Okay, I will share Excel sheet. Where is my Excel sheet? Okay. Right. Can you see my Excel sheet?
Yes, sir.
Okay. Option A, option B, option C. Okay. Right. Option C. You have 1 million. You have 1 million. So there are 3 choices. Okay. Right. You invest your money, option A, option B, option C. So this is payback period. Payback period. There are advantage, right? Disadvantage also there. There are advantage and disadvantage also. So we consider here only the payback period. How much, right? You invest 1 million. How many years it will be take to get back this 1 million, right? So option A, you invest 1 million, year 1, year 2, third year, fourth year, fifth year, sixth year. Okay. First year, you get 100,000. Okay. Second year, 150,000 you can get earnings. Third year, 300,000, right? We say not 300,000, 200,000. Year 300,000. Right. 250,000. Year 200,000. Right. Year 450,000. Right. In option C, A, your initial deposit or investment is 100,000, 1 million. So how many years it will be taken to get back this amount? First year, 100,000. Second year, another 100,000, 150,000. Third year, 200,000 and 300,000. Fifth year, 250,000. So end of the fifth year, right, after 5-year completion time, you can get back your investment initial money. Take 1 million, no? 100,000, 150, 200, 300,000, 250. Right? So 1 million, you can get 1 million after 5 years time. Right? If you invest your money in option A, in payback period, end of the 5 years, you can get back your initial deposit. After 5 years, 6th year, 7th year, those are your profits, no? Those are your profits. So within 5 years, you can get back your initial amount. Right? Then you can take any decision. We can't take any decision. Why? We calculate only option A, no? So when you calculate option B and C, see your results, then you can get the best option. So in option A, the payback period is 5 years. Understand? Any questions, please ask. 5 years. How we calculate this payback period? Your initial amount is 1 million. First year, your return 100,000. Second year, 150. Third year, 200. Fourth year, 300. Fifth year, 250. So, end of the fifth year, total 1 million you can recover. The payback period is 5 years. See the option B, right? Option B. 100,000, 200,000, 300,000, 400,000, and 350, and 250, and 200. Right? Here, in option B, first year 100,000, second year 200, third year 300, fourth year 400,000. End of the fourth year, you can get back your 1 million. So payback period is 4 years. Sorry, 4 years. End of the 4 years, you can get back your money. Then you have two options. If you invest your money, option A, 5 years time takes to get back your investment. If you choose option B, 4 years time takes get back your initial deposit, initial investment. So here we consider only payback period. Okay. Other things are not considered. Only consider payback period. This is one method. There are some advantages also there, but we will discuss later. But the method says the payback period, no. So option B, A, when you choose option A, 5 years times takes to get back your deposit, initial amount. Option B, 4 years time takes you get back your 1 million investment. Option C, right? Option C, 350, right? 300, 250, right? We say this. 400, 350, right? 200, 150, 100, 50. Here, in option C, first year 400,000, second year 350, third year 250, right? End of the third year, you can get back your initial investment. Okay. Here, payback period is 3 years. 3 years now, right? When you select investment A, option A, if you invest 1 million, right? 5 years time takes to get back this 1 million. If you choose B, option B, 4 years times take to get back your investment. If you choose option C, 3 years time, it will be take, get back, pay back your, get back your initial investment. So based on this method, payback period, which option is selected? Option C. Why? Here you consider only your risk, right? You consider only your recovery. Within short period, right? I can get back my investment. So I consider only the period, time period. So I select the option C because within 3 years, I can get back this initial amount. I don't consider about the payback period, right? In 7 years time, you think the total amount, what are the total amount, right? Your option A, after 7 years, your total profit, how much? 1.65 million. 1.65 million. Right? This is the total profit. Here, 1.8 million. Right? Here, 1.5 million. Right? You see the profit. The payback period is 5 years, 4 years, 3 years. This is payback period. When you consider only payback period, the short period is 3 years. So you consider only your time period. Your purpose is within short period, I will get back my investment. So if you choose option A, you have to wait 5 years time to get back your investment. If you choose option B, you have to wait 4 years to get back your investment. If you choose option C, you have to wait only 3 years. Within 3 years, you can get the all money. So you select which option? Option C, based on payback period. Right? You consider only the payback period. But the lifetime of investment is 7 years. The lifetime is 7 years. I say the disadvantage. What are the disadvantage? Here we consider only the payback period, no. But here, after the end of the investment period is 7 years. The maturity period is 7 years. End of the 7 years, the total profit, when you select option A, the total profit is 1.65 million. When you select option B, the total profit end of the 7 years is 1.8 million. If you choose option C, the total profit is 1.5 million the end of the year. So based on this total profit, the end of the year or the end of the maturity period, when we consider the maturity period, the profit, which option is best one? Option B. Why? If you select option B, first year 100,000, second year 200,000, but end of the period, the total profit, your total profit is 1.8 million. 8 million. But here you select which one? Option C. Why? You consider only the payback period, no? You consider your risk, minimum risk. Within the short period, you get back your investment. But the end of the maturity period, your total profit is 1.5 million. So you, right? Your decision is right or wrong. If you choose option C based on this payback period, that right, you lose your profit. This is the disadvantage, right? This is one method. So some person, the perceptions are different. No? My thinking way and my expectations are different from yours, right? We are not equal. We are not equal. My thinking pattern, my expectation, my targets are different from others. These are the human beings. No? Here, three options are there. We have given the returns. You invest 1 million. You can invest 1 million. These three options, there are three options. The earnings are given. The returns, profits are given. The lifetime is 7 years. Right? End of the 7 years, if you invest option A, you can get 1.65 million. If you invest option B, you can get 1.8 million profit. If you invest option C, you can get only 1.5 million. So if you consider the total end of the maturity, if you consider the total amount, the selection, the best selection is option B, no? Option B. But when you consider the payback period, you consider only the period, no? Within short period, you get back your money. So your choice is C. But in long term, your choice is right. That's a problem, no? Right. Okay. This is the advantage of this method. Here we consider only the time period, not only the profit. Not only the profit. Okay. Right. This is called payback period. Understand? Can you calculate this payback period? Any questions? Right? So here, another example. A company expert to invest on an investment which has a value of 500,000. Expected to annual cash flows are 100,000 every year. Calculate the payback period. The initial investment is how much? 500,000. The expected annual cash flow 100,000. Annual cash flow 100,000. Your expected investment is 500,000. So calculate the payback period. First year you can earn 100,000, second year 100,000, third year 100,000, fourth year 100,000, fifth year 100,000. So end of the fifth year, you get 500,000. Why? Your earning is 100,000 per annum, annually 100,000. So 5 years time, you can get your end of the 5 years, you can get your initial investment. So here payback period is how many years? 5 years. Okay. You can calculate using this equation. Payback period equal initial investment divided by annual net cash flow. Initial investment is 500,000. Annual cash flow equal 100,000. So you can divide it by 500 divided by 100,000. So 5 years. But the earlier example, your annual net cash flows are not equal. Not equal, no? Therefore, we can't use this equation. If your annual cash flows are equal, then you can use this equation and easily calculate the payback period. Okay? Right. This is one method. Right? IRR, cost-based analysis, there are so many methods. But I like to discuss the best method. The best method is net present value. Net present value mean here we consider the value for money. The value for money. What do you mean by the value for money? If you earn 1 rupee today, right? The value of one, right? Value of 1 rupee is in 1 year time, or the next month, or 3 months, after the 3 months, equal. No. Why? You know the inflation. Inflation. If I have 100,000, I purchase, right? Pay 100,000 and purchase some amount of goods. But after 1 year time, can I purchase the same amount by paying this 100 rupees? Right? Think our country, the market analysis. You know the inflation, price increasing. Right? Can or can't? Can't. Why? The inflation. The prices are increasing. So I can't purchase the same amount when I purchase today. Okay? So when we take a decision, right, we consider not only payback period, not only profit, we consider the value for money, cash value, the present value. We call the present value. Present value. Right? That is the best selection. Okay? So you think the 5 years back, 5 years back, right? Your salary 25,000. Now your salary 50,000. Your salary, the salary increment are there. But at that time, your purchasing power equal to now your purchasing power. Right? No, because at that time, the price level were low. Right? The inflation is low. But now prices are increasing. There's a inflation. So we can't purchase the equal amount that we purchased 5 years back. Okay? So when you take a decision, investment decision, we consider the present value also. We consider value for money, cash value, present value. Right? That is very, very important. Right? So the best option, the best method is net present value, using the net present value. This is the best method for evaluating investment. Okay? Understand? Right? This could be identified as the best method for evaluating investment. There are few steps to be followed calculating net present value, right? There are few steps. First, number one is you calculate the cash flows. What is cash flows? Cash flows means, inflow and outflow. In investment side, there are inflows and outflows. What is inflows and outflows? Inflows mean you receive money, your earnings. Your earnings, and when you receive money, we call inflows. Inflows. When you pay or when you make expenses, that is called outflow, no? If you invest money, if you invest 500,000 for a project, that is called outflow. Your money is going out, no? That is called outflow. When you receive incomes, money come back, you receiving. So that is called inflow. So first of all, we need to calculate our cash flows. So you should identify clearly what are the inflows, what are the outflows. Okay. Otherwise, you can't calculate this method. So you should understand clearly what are the inflows, what are the outflows. What are the inflows? Earnings, income. Income is inflow. Expenses and investments are outflow. Okay. Number two, calculate the net cash flow. Net cash flow mean net amount mean the net salary. If you take your pay sheet, there are three items, no? One is earnings, basic salary and other allowances. We call altogether these two, basic salary plus other allowances, we call gross salary. Gross salary. And we deduct some deductions, salary deductions, stamp duty, loans, festival advance, right? And other charges, welfare fees, right? So there are some salary deductions. So we deduct salary deductions from gross salary. Finally, we get what? Net salary. So net salary equal gross salary minus deductions, no? Okay, understand? So you see the profit. How we calculate the profit? Earnings, revenue minus expenses. Revenue minus expenses we call profit. The same way we calculate the net cash flow. Net cash flow means cash inflow minus outflow. That is called what? Net cash flow. Inflow minus outflow. Sometimes plus minus are there. If your cash inflow is higher than outflow, the amount is plus. If your cash flow inflow is right lower than outflow, the net amount is minus, loss. Right? Your earnings is 100,000, your expenses are 80,000, then plus 20,000, no? Inflow 100,000, outflow 80,000, so plus 20,000. For example, your inflow earnings 100,000, your expenses outflow 120,000. So inflow 100,000, outflow 120,000. There's a minus 20,000 net cash flow. So net cash flow will be plus or minus. Okay. So first of all, you identify your cash flows. There's a cash flows mean inflows and outflows. Then calculate the net cash flows. Net cash flows mean inflows minus outflows. The third step is find out the present value. Present value mean here there's a formula. There's a formula. Here we consider the discounting factor like a interest rate, discounting factor. The discounting factor represent the inflation, okay. So you will be given the discounting factor. Using discounting factor, you calculate the discounting factor. How do you calculate the discounting factor? Right? Don't bother about the calculating discounting factor. We will discuss later how we calculate the discounting factor using this formula. I will discuss later. Right? Right? Okay. Now you understand, right? There's a discounting factor. The discounting factor will be given. So using this discounting factor calculate based on the inflation. The factor, right, reflects the inflation. Okay, right. Using this factor, we calculate the net present value. Net present value means today we call 1 rupee. Next year, right? Today's 1 rupee equal how much next year? Oh, when you say 1 rupee in year 2026, the value, present value of 1 rupee, right? Today, the present value of 1 rupee, how much? In 2026, you say 1 rupee. I have 1 rupee. You will be have 1 rupee. When? Next year. So that 1 rupee equal to how much today? 1 rupee O less O higher. It should be less. Why? Why? Because of inflation. Today I say 90 cents. Today I say 90 cents. Then the 90 cents worth or 90 cents equal 1 rupee for next year, 2026. Today I say I have 90 cents. And 1 year back, I say I have 1 rupee. So next year 1 rupee equal to how much? 90 cents today. It means if I have 90 cents, I using these 90 cents and purchase some amount of goods. In 1 year back, after 1 year, 2026, I have 1 rupees. I use that 1 rupee to purchase some amount of goods. Those goods are equal to what are the goods today I am purchasing. I purchase some amount of goods today using this 90 cents. After 1 year, I will purchase the same amount of goods by using or spend 1 rupee. Today I spend 90 cents, but 1 year, after 1 year I spend 1 rupee to purchase the same amount of goods. Why? What are the, why? Right? Because of inflation. Because of inflation. Okay, that is called net present value. So we calculate net present value. These are the steps. Okay, first you understand and identify the cash flows and calculate the cash flows, inflows and outflows. Then you calculate the net cash flows. Do you know how do you calculate the net cash flow? Inflows minus outflows, and to find out the present value, right? How we find out the present value? Using the discounting factor. What do you mean by discounting factor? Discounting factor will be given. The discounting factor represent the inflation rate. Then you calculate the present value. Okay, these are the steps. So we will do a exercise, right? This is the example of calculating this net present value. I will explain you. Year 0, 1, 2, 3. Year 0 mean the investment year. When you invest your money at, right, then we consider year 0. Why? Now I invest a certain amount of money. End of the year, I receive the investment, no, the return, no? Right? Today I invest. Right? Is it possible to earn money today? Or earning incomes today? No. The end of the period, end of the year, we consider end of the year. End of the year, only we get returns. Okay. So the year 0 mean deposit, the cash outflow. Here you see first year, so 0 year, initial year. Now I invest 50,000. Invest mean investment, no? Investment. Investment mean I invest 50,000. That is, we call cash outflow. Why? I paying 50,000, right? For what? For investing, for invest purposes. So that is called outflow. The first year, end of the first year, second year, third year, I receive income. That is called earnings. Earnings means cash inflow. Okay. So we, right? You should clearly identify the cash flows. The initial year, we deposit. So that is called cash outflow. That's why the 50,000 put within the bracket, right? Sometimes we can put minus also. Minus mean outflow, right? The end of the year, first year, the return is 50,000. So earnings 50,000, inflow. End of the second year, your earnings is 30,000, inflow 30,000. Third year, 30,000, the income, so inflows 30,000. Understand? The discounting factor. Discounting factor means the value of rupees is equal 1 rupee today. Understand? The value of 1 rupee is equal 1 rupee no today. But the value of 1 rupee equal 1 rupee for next year. No, the values are different, no? Because of inflation. So here the logic is this. The logic is this. We consider 1 rupee. Today I say 1 rupee. So 1 rupee equal 1 rupee today. But next year I save 1 rupee. Next year, 1 rupee equal today, how much? Next year, I say 1 rupee. The value is 1 rupee in next year. The value of 1 rupee, next year 1 rupee, how much in today? In today, less than 1 rupee, no? So today I say 90 cents. But the 90 cents equal to 1 rupee in next year. The second year says 1 rupee. The value of 1 rupee in second year equal to 80 cents today. The value of 1 rupee in third year equal to 75 cents today. Right? If I have 75 cents today, I buy some much of goods. But the same amount of goods I want to buy in third year, at that time, I need 1 rupee. Today, I need 70 cents. The third year, I need 1 rupee for purchase the same amount of goods. Why? Inflation. The prices are high. I can't buy the same amount of these goods by paying 75 cents after third year. Can't. Why? The prices are increasing. So I need 1 rupee, right, in third year. But today, I don't need 1 rupee. Right? I need only 75 cents. 75 cents to buy this good. For example, right? If you take, for example, if you want to buy a pencil. If you say 20 rupees, today 20 rupees. So I spend 20 rupees buy a pencil. Okay? Today. But the next year, I want to buy the same pencil. Can I buy paying 20 rupees in next year? No. Why? Inflation. Prices are increasing. So in next year, I need 20 rupees plus inflation. That right? So sometimes 25 rupees you need. So next year you need 25 rupees for buying this pencil. But today you need only 20 rupees. How about third year? Today you need 20 rupees for buying this pencil. Next year you need 25 rupees for buying the same pencil. In third year, you need much more. How much? 30 rupees you need to buying this pencil. Why? Inflation. So here we consider this inflation that is called net present value, discounting factor. This calculation is, right, represent the present value. This is the best method. Okay, right. Here you will be given the discounting factor. First year 1 rupees, no? 0 year 1 rupee. End of the year mean first completion of first year. End of the year. The discounting factor, there is a formula. If you put this discounting factor, that formula, then the amount will be calculated. Okay, here the discounting factor also given. Don't worry, how do you calculate this factor? We will discuss later. The net cash flow also given, right? So you have to calculate the discounting factor. Okay, so I will open Excel sheet. Excel sheet. Okay. This is the questions, right? So here 0, 1, 2, and 3. Right? Right. Discounting factor 0 here, 1 rupee. Right? Zero point 909. Second year 0.826. Sorry, 0.826. And here 0.751. Right. These are the discounting factor. And cash flow, net cash flow. This is cash flow. Huh? Cash flows. Cash flows. How much? 50,000 minus. Why minus? Outflow. Investment, no? When you invest money, the cash outflow. Okay. And 40,000 and 30,000 and 30,000. Right. These are the cash flows, inflows and outflows. Then you have to calculate the net cash flow. How do you calculate the net cash flow? 50,000 into discounting factor. How much? 50,000 into 1, no? So 50,000. Right? Equal 50,000 into discounting factor 1. So the amount is 50,000. 50,000. Then first year, the discounting factor is 0.909. So cash flow inflow, no? 40,000. The discounting cash, net cash, discounting factor, net cash flow, right? Net cash, NPV, net present value. How much? 40,000 into discounting factor, 0.909. So 36,306. Next one, 30,000 into 826, 24,000. Next year, 30,000 into 7.751. So 22,530. So these are the net cash flows. It means end of the third year, you say 30,000. The 30,000 worth, how much today? 22,530. Today, 22,530 rupees equal to 30,000 in after 3 years. That is called net present value. Today, 50,000 equal to today 50,000, no? Okay. Then today we say 36,360 is equal to 40,000 next year. Today we say 24,780 is equal to 30,000 next year, second year. When you say 30,000 in third year, that 30,000, right, third year, that is equal to how much today? 22,530. That is called net present value. So we consider the net present value. Here, if you get the total amount, how much? 50,000. Why? Plus and minus, no? Plus and minus. Minus 50,000. This 46, 30, 30. So 150 minus 50. The net cash flow, how much? You calculate this amount. How much? Right? 33,670. Right. These are the discounting factor. Right? End of the third year, our total return, inflow and out net cash flow, right? 50,000. But that 50,000 equal today 33,670. That is called net present value. Understand? Is there any questions? Please ask. Any questions? No questions. Right. These are the calculations. I have done these calculations. So here, another example, right? The cash flows, net cash flows are given. End of the first year, 10,000, second year, 25,000, third year, 15,000, fourth year, 10,000. The discounting factor, 0 year, 1 rupees. Here we assume the inflation is 10%. Okay, the inflation is how much? 10%. The amount is inflation is 20%. This the same discounting factor we can use? No. If the inflation is 5%, we can use this discounting factor? No. This is based on 10%. This inflation. We assume only 10% inflation. So the discounting factors are given. Your net cash flow. Net cash flow, you know, inflow minus outflow. These are the net cash flow. These are the inflation. So we can we calculate the discounting factor? Can we calculate this discounting factor? Right? right? Try to calculate, not 0 here, right? Here 1, 2, 3, and 4. Discounting factor, right? First year 0 point, right? 99, 0.826, 0.751, and fourth year 0.683. The cash inflow, net cash flow 10,000 and 25,000, 15,000 and 10,000. So the total net cash flow, how much? 60,000, right? 60,000. The net present value 10,000 into 0.909. So net present value automatically, if you give the formula, automatically the calculations, we can get the calculations. And the total amount 47,835. 47,835. Right? These are the total net present value. Okay? This is the way to calculate this net present value. That is simple. So when you say 60,000 after 4 years, that 60,000 equal how much today? 47,834. Today I say I have 47,835. That amount equal to 60,000 after 4 years. Right? Why? The inflation. Inflation means prices are, right, increasing. Okay? So NPV represent the value for money, the present value, present value. Okay? Right. So this is the answer. This is the answer. I have calculate those answer using Excel sheet. Okay. Next one. This is another example. I will explain this example. Right? The above example, if you say initial amount means investment is 60,000. If you say investment is 60,000, what happened? What happened? Right? I open the Excel sheet. Right? You see, the initial deposit is 60,000. 0 here. 60,000. Sorry. Initial deposit is 60,000. 60,000 mean investment. Investment mean outflow. Right? Then, right? The net cash flow 60,000 outflow into 1. So minus 60,000. The net right? The net cash flow is How much? 0. Right? Here. How much? Net present value. Right? Minus 12,165. Minus 12,165. Minus. So net cash flow is 0. The net present value is minus. When the net cash flow, net present value is minus, right? Those type of investment worst. Don't select minus net when the net present value is minus. That type of project is not worth. So give up. Right? When the net present value is 0, right? No profit or loss. The risk is no risk, no profit, no loss. Right? So if you want, you can select or leave it. If the net present value is plus, that is good. Right? If the net present value is 0, don't select. That is the logic. If you evaluate the project, 1 or 2 or 3 projects, the net present value is plus, you can invest. You can invest. You can select those type of projects. Right? If the net present value is 0, then also you can select. When the net present value is minus, don't select. For example, project A, right? Project B, project C. Okay? Project C. The NPV, net present value, is project A. Okay? Project A, the net present value is 0. Neither profit or loss. Okay? Project B, the net present value is plus 9,500. Project C plus 7,000. Right? Now you see 3 projects, A, B, and C. Net present value is 0, right? In A project. In B, plus 9,500, C, 7,000. So you can select these 3. But the best one is which one? B. Why? The plus higher than C. So you select B project. Next example. Next one. The NPV A minus, okay, in project A, minus 2,500, right? B minus 1,000. C minus 850. Right. Look about these three. We calculate NPV in projects A, B, and C. All are minus NPVs. Minus NPV means, right? Can we select this investment? No, worst investment. So we don't invest money to A, B, or C. No investment are there. Why? The NPV is negative. Okay. If you see the project C is 0, A and B minus, C 0. Now your decision is, you can select which one? C. Why? A minus, B minus. So we give up these two and the option is C. You can select C. When the NPV amount is plus, you select the plus amount, high amount. Right? When all are minus, don't select. Right? Here, plus plus 250. Then A minus, don't select. B minus, don't select. C plus 250. Above 0, no? 0 or above 0. So you select, your option is, your choice is option C. Here option C. Right? Here, which one? Option B. Why? Option B, NPV of option B is higher than option C. Right? All are minus, no selections. All are plus, select. Right? Which one? The higher NPV. Okay? These are the decision making logic. Okay? So I think you can calculate the NPV. So this is project A. So you take the discounting factor and the cash inflows, not cash inflows, cash flows, inflow and outflow. Outflow mean minus, inflow mean plus. Okay, and the discounting factor calculate based on the inflation rate. This is the 10%, right? When the discounting factor is the inflation is 15% or 20% or 10% or 5%, the discounting factor, right, will be changed. Okay. The investment here we say 0, right? Here 0, initial investment. After 1 year, we get profit. Okay. So this is the table, right? And if you put the table and give the formulas, the calculations automatically comes, right? Then we calculate the NPV. This is for project A. The same techniques we use for calculate the project B and C. Finally, we get the chart, this type of chart, NPVs A, B, and C. Then analyze the NPV. If the NPV, all NPVs are minus, right? The three projects are worst. So don't select. We can't invest. If the NPVs are 0 or above 0, now you can select. Right? The higher NPV should be selected. Okay? Right. This is mathematics. Okay? So here are some questions also. for your calculations, right? Here, new purchasing price. Purchasing price mean investment. You purchase machines. Machines mean you invest your money for machine, no? So you purchase machine, 300,000. There are two options, machine A and B. A and B. So you calculate these two projects, NPV of these two projects, and you can take final decision. Okay, I will do these questions also. Okay. Right. Right. Uh, Machine X. Machine X. Right. Fourth year, discounting factor 0, the same. Okay. Uh, okay. The cash flow first year is 300,000. 300,000 mean minus. Okay. Outflow, no? Right. We purchase machine. Machine purchase mean outflow. Right. End of the first year, the income is 90,000. Second year, 100,000. Third year, 150,000. Fourth year, 150,000. Right? The total earnings, total net cash flow, 190,000 after 4 years. The discounting factor, 300,000 into 1 minus 300 outflow. And the first year, second year, there's a discounted factors and the earnings. So net present value, 81,810, 82,600. Likewise, total NPV end of the 4 years, 79,550. This is machine X. So we have to calculate machine which one machine machine Y. Okay. Right. Machine Y. Machine Y. Right. Right. Machine Y. Machine Y, you know, initial 300,000 outflow and 80,000, 90,000, 100,000, 90,000. These are the cash flows. So end of the year, 60,000 net cash flows, and the discounting factor minus 300,000 and plus 72,702. So the total NPV 16,370. Okay, machine. So the summary is machine X, machine Y, NPV X NPV is this, no? How much? Plus 79,510. 79,510. The Y, how much? Minus 16,370. Right? This is plus, this is minus. So, this is minus, this is plus. Right. So the finally we calculate the net NPV, total NPV, net present value of machine X 79,510. The total net present value of machine Y 16,370. So the two NPVs are there. Y is minus, so we don't consider about minus. So our selection is machine X. When we invest the machine X or when we purchase the machine X, then we can earn more profit. When we invest the machine Y, there's a loss. So our choice is this. You see, end of the fourth year, our net cash flow 60,000 when we invest the machine A. But when we invest the machine X, our net cash flow 1,900 rupees. So the after 4 years we say 190,000 rupees is equal how much today? 79,510. Why? Because of inflation. Right? When we invest the machine by end of the fourth year, we can get 60,000. The earnings are inflows 60,000, but the worth, the end of the fourth year 6,000 equal how much today? Minus. So minus, why we are going to invest this type of investment, right? The net value is minus, no? Therefore, our selection is option, so machine X, right? If you don't consider NPV, so we can say, this is 190,000, 60,000. So both are profit. Both are profit. No. If you consider the value for money, the machine buy is not worth, plus. So our selection is this one. Therefore, the net present value is very, very important and best way for select the or the evaluate the investment. Okay. Right. Those are the things I plan to discuss today. This topic is very, very important, right? And like a mathematics calculations, okay? So I will share this presentation and questions in your WhatsApp group, okay? Try to practice this NPV calculations and payback calculations. This is very, very useful subject in your personal life also. So today the topic is there are three topics: investment and calculations, right? Another chapter also. So I have discussed 3 hours, right? But I covered these two, right? So investment opportunities, evaluating investment, right? I have no time to discuss microfinancing and lending facilities. I will discuss these topics next sessions. I have we have another 1 or 2 sessions, modules. Okay, I will discuss these sections, right, in later. Okay, right. Is there any questions about these calculations and investment explanations, right? You can ask. Otherwise, we can stop our discussion. Okay, right. Is there any question you can ask? No questions?
No, sir. It's
Okay.
clear.
Is those are clear?
Everything is clear,
No
sir.
any response? Okay. Now I'm going to stop my discussion, right? I will upload this presentation tomorrow. Okay? Right. Okay. Good night.
Good night, sir.